Home prices in Vancouver have now dropped for the 8th straight month in a row, and prices are now back to a 33-month low. The November stats are out, and we've got all the key metrics to share with you today, as well as we're going to highlight a project in the West End that was approved 7 years ago, but share with you the reasons why they still have not yet broken ground. On top of this, we see the continued drop in rental rates, resulting in REITs notifying their shareholders that dividend payments are being slashed dramatically. And there's also an update in the arrears data that shows how Canadians are handling this mortgage renewal wall, at least so far. And of course, we got the Bank of Canada on deck next week, and we have all the data that shows whether that you should be expecting a rate cut or not. Let's dive in. So first off, we want to talk about kind of a theme that's been very prevalent for the last couple of years, and that's the extreme challenges that developers are facing when it comes to their ability to bring affordable and desirable homes to the marketplace. The market turned down, higher interest rates, a glut of inventory, massively increasing city fees and taxes are all resulting in a widespread reduction in building permits and, of course, future shortage in housing. So another story about developer issues has come to light just this week, and it's in regards to two towers, a two-tower development in Vancouver's West End that was approved, rezoned 7 years ago, but it still hasn't broken ground. So the original design for these buildings included 129 units of market rental housing. And this is a key point here. On top of them having to do and supply market rental housing, to help the community and to help get their permitting approved, they had to make $75 million contribution to the city for the community amenity contribution charge, $75 million. That charge equates to $169,000 per unit in that entire development, and gives you a quick insight into why homes cost so much, especially in our city and province. I mean, you're literally adding $170K just out of the gate. That, of course, is absorbed and paid by the end user. So what they're trying to do now is do a revised zoning application that will include 51 social housing units, which would drop the market rental unit count down to 78. So this would replace a portion of the cash in lieu payment to the city. So instead of paying the $75 million, which starts to make these projects unviable, they're like, okay, well, let's do some social unit housing, which they don't have to pay the cash in lieu for. So the two towers then would otherwise remain the same. And these are big, right? One of them is 48 stories. The other one's 43 stories in height. And it would result in a remaining 314 strata-titled units for sale. So since acquiring the land 8 years ago, the CEO of Landa, the developer, said the project hasn't moved forward as the market has shifted significantly and basically all the other reasons I outlined earlier. And they're basically looking for creative ways to make this project feasible again, right? Imagine holding that land for 8 years and the holding costs that comes with it, and them not being able to break ground because of all the market and dynamic shifts and extra fees and whatnot that have come to light. They also are looking to transition the unit types as well as removing the, quote, passive house certification that was going to help make the pro-forma pencil, right? Building to that passive house certification level is expensive, different materials, different building codes, and so forth. And so they're looking to remove that. Though do realize the current building code in Canada and BC, it is at a very high degree, and it's only just behind the passive house certification level. But all in, I mean, look, here you go. Here's yet another story that demonstrates how hard it is for developers to bring homes to market at a price that consumers can afford and at a price where they won't lose money by bringing these properties to the marketplace.
When you consider $169,300 per unit, that's $170,000 tax on each unit that gets sold, right? Now, you could argue that there's a community amenity contribution that you're going to get, but we still don't know what that would be or where all of that money would go. And then you tack on the passive house certification as well. And it's sort of these requirements that are coming from the city, both the municipal tax levy that's come in, and then building to a standard with, like a zero carbon footprint. I mean, what's more important here? Actually putting more houses up for people at an affordable cost, Or are we going to continue down this sort of like virtuous perspective of having to always create the most, environmentally sound building? It's there's a time and a place for it. And, when prices are as high as they are, I think we have to look at what's more important. And to me, it's putting more affordable homes into the marketplace and not stuff that just costs an absolute bomb and then adding $75 million to the development. I can't get my head around what's more of a crisis. And to me, it's affordability. But anyhow, let's move on. Let's have a look here at the REITs. With rental rates dropping across the country for over a year now, it's no surprise that REITs are being affected. And in return, they are paying out less to investors. Allied Properties just announced they are slashing their monthly payouts by 60% and will continue to liquidate assets to lower their debt levels. Their stock is also down 40% since October, and with a record number of rental units under construction across Canada and adding in negative population growth for 2026, rental rates will continue to fall for the next 18 months now. And you can expect to hear similar stories from other REITs to come to light over the next year or so.
So quick shift here into mortgages within Canada and the arrears rate, because the latest update from the CBA is out regarding how Canadians are handling their mortgage payments and who are in arrears, being 3 months or more of missed payments. Month over month, the arrears rate nationally, it did not change. It remained the same at 0.24%. Ontario, on the other hand, though, did see a notable increase. They jumped from 0.23 up to 0.25%. Here in BC, well, we're remaining pretty stable. Did not move month over month, staying at 0.21%. Saskatchewan and Alberta saw their arrears rate lower or improve month over month. And Canada still remains below pre-COVID level for arrears. We're now, about 6 months into this quote unquote renewal wall, the mortgage renewal wall, where people are renewing at higher interest rates and therefore have higher payments. So far, so good in respect to these mortgages continuing to be paid. Though let's keep in mind here, I think the real test for this will come in 2026, because 1/3 of all mortgages in Canada are renewing next year. And most of those, understandably, will see higher payments. So even still, when we look at the big picture, almost every province still has an arrears rate well below the 30-year average. While Saskatchewan is slightly higher, we see Manitoba, the Atlantic provinces, Alberta, Ontario, BC, Quebec, all have below average arrears rates. Even Canada as a whole is running about 32% below its 30-year average. So again, the story rings true. Canadians are still paying their mortgage first. Of course, there's stresses all over the place financially, but the mortgage remains one of the key things that Canadians feel the need and desire to continuously pay.
Dan, question for you. Do you think that arrears rate's going to rise in 2026 from where it is today?
Yep, but I don't think it's going to go to any level that is going to be the breaking factor, right? The highest that it's been recorded was around 0.62, if I remember correctly. But the interesting to note about that is while the arrears rate was at its all-time high, prices nationally were actually increasing. Again, just demonstrates that it's not just one metric that causes prices to fall or rise or stay flat, but high arrears rate does not necessarily equate to prices falling. Because here we go. We've got low arrears rate and we've got prices falling. We've had high arrears rate and prices increasing. They don't always correlate. But yeah, I can't imagine it'll go anywhere but up, but not to a shocking degree, and it will not break all-time highs.
Yeah, and then I think if you add in the decline in mortgage borrows here on this next story, it'll probably keep the number at a reasonable rate. But this one is pretty interesting. The number of active mortgages on bank balance sheets is now declining. The CBA data shows that there are nearly 2% fewer mortgages held by banks than just 1 year ago. This is an unprecedented decline not seen in 35 years. And typically, we see an annual increase of around 2% with peaks in and around 5%. So the decline is incredibly unusual. After hitting a peak of about 5.1 million mortgages in 2022, the decline has brought that down to about 4.94 million mortgages today. So you got to ask yourself, what would be causing this? One guess is the jump in home sales in Quebec and all the growth in home sales nationally over the last 2 years that have come from that province. And nearly 50% of all mortgages are held by credit unions there, which do not show up in the CBA data. There could also be a higher than average number of mortgages that were paid off during the helicopter money phase of the pandemic, the same period where we saw a record amount of deposits into major banks. Those with the means may have seen higher interest rates coming and paid off their mortgages or their balance outstanding. And fewer purchases over the last 2 years will also contribute to this, with increasing inventory across the nation and a record high level of completed and unsold inventory that's also available as well. Also, with rental rates continuing to lower, some may choose to get out of higher mortgage payments for lower rental rates, all contributing to a very interesting shift we're seeing in mortgage holders. And of course, we'll continue to keep you updated on it.
So everybody holding a mortgage today probably has an eye on what's happening next Wednesday at the Bank of Canada, because they are on deck to make their next rate announcement. So what is it? Thursday, December 4th, 11:20 a.m. when we're recording this. And as of this time of recording, there is a 94% chance of a hold on the December 10th meeting. So in fact, if we look out even further, and as of right now, there are actually no rate cuts expected to happen in all of 2026. So this rate that we have today, the overnight rate at 2.25%, may be the rate that mortgage holders can expect for at least the next 13 months or so, maybe all the way into 2027. Understandably, a lot can change between now and the end of next year that can shift the Bank of Canada's position on whether they should increase or cut. But if you're waiting for interest rates to go lower, you might be waiting at least a year, based on the predictions we have today. And the chance of a rate increase may actually come to light before another cut does, right? We're going to obviously keep an eye on inflation to help give us an indicator of that. But let's go bigger here. Let's look at the historical average for the Bank of Canada's overnight rate for context. While, of course, we all remember the beautiful overnight rate of a quarter point about just almost 5 years ago now, that was far from common and far from normal. In fact, if we go all the way back to 1990, the long-term average for the overnight rate of the Bank of Canada from 1990 up until today averages 5.76%. So even if we strip out the peak overnight rate in the 16 or 17% that took place around 1991, and we go, let's say 1992 up until today, the overnight rate long-term average still sits slightly above 3%. So all this is to say that, you look at 2.25 point today, and it can be considered a lower than average rate. So, of course, sure, yeah, home prices were much lower, historically than they are today for the vast, period of time of these historical rates. But I guess what I'm trying to say is frame up in your mind that, the interest rate available today may very well be the lowest we see for many years to come. So sure, there might be a few basis points jump, up or down here, but it might be time to recognize that, look, 2.25 point is the reality of what is quote unquote good, or what a quote unquote good rate looks like today. We might jump forward a year or two and go, my goodness, 2.25 point. I wish we had those rates again, because things could easily increase. So, not investment advice, but, based on the outlook here, 2.25 points may be the low level of rates that we see for the foreseeable future. So any plan to purchase or sell or invest on the fact that the initial indicators are that rates could, ultimately go up in 2026, those are becoming more frequent. So reframe your mind at what 2.25 point actually looks like, and, plan accordingly.
Dan, I think that's really good advice. And the reason for that too, just to add something to it, is you've got to consider where the US interest rates are right now as well, and the size of the Canadian budget that's going to get spent into the economy, whether it's investment or whichever side of that balance sheet you want to see it on, it's still spending. And at the end of the day, You're going to have a large influx of capital. And then you're also going to have the US cutting rates well into 2026. Remember, we're over 2 basis points higher. I think they're 2.25% higher than we are right now. So I would expect you'll see cuts through the US. I think interest rate cutting will be the story of the US in 2026. I think people in Canada shouldn't really consider rate cuts at least until the end of the spring in 2026, because we have a lot to see what happens here. But I just think when you look at rates cutting in the US, in addition to the Canadian spending, you've got inflation that's going to rear its ugly head. And like you said, I think the rates that we're seeing now are worthwhile locking into for a longer period if you can. Let's have a look here at home prices in Toronto, because they are now down 25% since the 2022 peak. And that's after lowering another 0.5% last month. Average home prices now sit at $951,700. That's down 5.8% year over year. And while that seems like a high number, do note that that is nearly a 26% drop in prices since the peak, which is down $330,000. Prices in the GTA are now back to January 2021 prices, and sales volumes were down 16% year over year to just above 5,000 units. The third weakest November in 15 years. Inventory now sits at a record for the month at 24,550. Man, that's a lot. December and January will have even slower sales volumes. So anyone who was waiting until the spring to kind of list, thinking it'll be a better market, I don't know. Or I think we're facing what looks to be a continued buyer's market with at or near record levels of completing listings in the marketplace.
So Toronto clearly remains sort of the epicenter of the downturn, and let's see how Vancouver has stacked up against it, because as we mentioned, the December stats are out, and here are the top line and the key important metric and market movers. So we always start off with the sales. How many units actually sold last month? That was 1,844. Pretty big drop month over month, as we typically see going into November, right? It was about a 22% decrease just month over month. But let's always look at the bigger pictures. First, year over year, sales were down 15% from November of 24, and they sit at 21% below that 10-year average. When we look at it from the even higher standpoint, Greater Vancouver is on track for 2025 to be the lowest sales volumes in at least the last 25 years. The lowest of this century is the headline that was out this week about that. So we're on track to sell fewer homes than 2018, which held the previous record for the lowest sales volumes. So it is just kind of grinding, and we're now, year 3 in a row of sales volumes and prices dropping, with currently no end in sight.
When you look over here at new listings, we're sitting at 3,677. That's a 48% decrease month over month. Again, not too outlandish month over month, but listings typically peel off big time this time of year. It's down 1.4% year over year, though 3% above the 10-year average. New listings in November were the lowest for any month in 2025 as well.
Even with kind of these reduced new listings, inventory continues to be a major headline story. Inventory, even though it's actually lowered 4 of the past 5 months, and today sits at about 14,640, it's still high. Yes, it dropped 12% from the month before, but let's look to a year ago, up 5.5%, and the 10-year average, it's sitting at 36% above the 10-year average, kind of a number that it's been almost all year. But again, let's look even bigger or wider. Right now, for the month of November, it actually closed out at a 13-year high for inventory. So that means, of course, we're going to go into December and January, which are typically these slower months. And that generally means with the depressed amount of sales volumes and record high, or 13-year high inventory, downward pressure on prices looks to be all but certain going into at least February of next year.
It's funny, Dan, when I read the odds, report from Remax or Royal LePage that comes out with the sentiment talking about how everyone feels like 2026 is going to be a bit better of a year, but there's nothing here suggesting that that might be the case. I guess we'll see. Let's have a look here at the sales to active ratio. This is sort of good measurement on the sentiment of the marketplace. Overall, we're sitting at 13%. That is borderline buyer's market territory. And that's down 1% from last month. So when we break it down by asset class, looking at detached, we're sitting at 9%. That is a buyer's market territory and down 1%. That's full on buyer's market territory. For townhomes, it's sitting balanced at 14%. That's down 4% though from the previous month. And 15% for condos, also sitting in that balanced market territory. No change since last month.
Let's jump into our foreclosure discussion now. It only changed minorly, but behind the scenes, it's a little bit more interesting. Detached foreclosures and land foreclosures both increased in volume, but condos continue to decrease month over month. All in, the month actually washed out with only one increase in total foreclosures. There are now 428 available across the lower mainland. This is, again, we're up dramatically from October 2024 when we started tracking this. That was 230 back then. So an increase again this month. It's been increasing almost every month this year, but that trend is currently slowing. But we'll see what happens, of course, again, as 2026 takes shape.
When we consider how long it's taking to sell your property, a surprising jump, though maybe not seasonally here. Days on market jumped up by 7, going from 22 to 29 days on market. So roughly taking about a month to sell a property that is priced to market.
And talking price, thanks for that segue there. So as we mentioned, HPI, it did drop for the 8th consecutive month in a row. It dropped about $4,000 last month, or 0.3%. It is now sitting at $1,123,700. When we go back a year, we're almost down 4% year over year. We're sitting at 3.9. And, there was a bit of a peak or a bit of a lift that we saw at the beginning of the year until Trump took power. And prices are now down about $62,000 or 5.5% since our 2025 high, which took place in March. This brings home prices back to February 2023 prices. That was actually 33 months ago. So we're at a 33-month low in prices. It's quite a dramatic pullback. Now let's also look at the two other price metrics, including median, which dropped 20,000, now sitting at 950K, and average also dropped. It was lowered by 25,000, now sitting at 1,240,000. So I think as we discuss what's going next, what's happening in December, January, maybe February, I think I made my position pretty clear earlier in the sense that, if you're coming off of 13-year highs with depressed sales, highs in inventory to depressed sales, obviously, that environment constitutes downward pressure on prices. I think we're definitely going to see lower prices wash out in December and January. February, I don't know, things can change there, but I'm not expecting any type of spring bounce, at least not on the data we have today. Lots can happen in 3 months, but Ryan, I don't know. What's your take on the next quarter here?
Generally, I'd like to be optimistic about the spring market. We talked about how there really wasn't much of a spring market this year in 2025. Not much of a fall market either. And we're 3 years now into a correction. I think you could go either way with what's going to happen in the spring market here. I do think prices have corrected to a point where some people are starting to see this as a time to get in. I wonder how people are going to weigh the interest rates versus the potential cost of units where we are today, and whether or not those will begin to correlate. We haven't seen it in the fall market here, but I think if people start to recognize that rates are going to be, this is as good as it gets, you could start to see a little bit more activity into the springtime. I just don't know to what degree that will happen, because overall we have to consider the economic output for Canada as well. And that right now doesn't look great.
People are spending money on Christmas presents instead of houses this month. That's a prediction.
Well, It's interesting too, Dan, because a lot of the headlines coming out in the U.S. about how this was going to be sort of the worst Black Friday ever, and I think it set records. Something like $11.2 billion was spent on Black Friday, and so you've got more people struggling with affordability and not being able to buy houses, but instead they're going and buying things that are depreciating and consuming. And it's just bizarre. It's very strange.
Well, yeah, my take on that is that the economic divide is so big, right? And the people that are the haves, the people that are in the top, let's call it 5 to 10%, they seem to be spending even more, and that data is pushing through, but they can't separate who's spending. So it's artificially kind of pumping up GDP and the economy in the country, saying that, look, everything's fine because, the numbers, the consumption numbers, the consumer index is increasing or breaking these records, as you said. But again, is it a smaller percentage of people that are causing those type of numbers to be realized?
Well, I think we looked it up the other day, and it was something like 50% of the population in the US has 2% of the nation's wealth. So when you consider economic divide, and you've got the top 1% accounts for 32% of the nation's wealth, it's just insane. So yeah, the economic divide is crazy. And you got to wonder, when you look at top line GDP, if prices for a cell phone doubled this year over last year, the same amount are sold, it's going to look like we're consuming more, when in all reality, we're paying more for the same thing.
That's it for this week. Thanks as always for tuning in and watching. Have a wonderful weekend, and we will see you here next week. Bye.